All right, let's talk about one of the most powerful yet overlooked skills in investing. We're going to get into the art of sizing up a company's leadership team, moving way beyond just the numbers on a spreadsheet. I want you to picture this. It's 1999. The dot-com bubble is in full swing. IBM, it looks like an absolute dinosaur, a relic. But a handful of investors saw something totally different. They saw brilliant leadership turning that ship around. And while everyone else was throwing money at hype stocks that eventually went to zero, those IBM investors made 10 times their money. That, right there, is the incredible power of getting management right.
So that's the billion-dollar question, isn't it? How do you spot that kind of game-changing leadership before it's obvious to the entire market? Well, I'll tell you, it is not about luck. It's about having a system, a framework for seeing what other people miss. And that's exactly what we're going to build right now. Look, the pros don't just throw darts at a board. They use a structured approach to figure out if a management team is the real deal. And it all rests on 4 key pillars. If you can master these, you're playing a different game.
So here they are, the 4 pillars. First, we look at their track record. I mean, do they actually do what they say they're going to do? Second, what's their corporate governance like? Are they looking out for shareholders or just for themselves? Third, and this is a big one, how good are they at capital allocation? Are they smart with your money? And finally, communication quality. Are they straight shooters or do they just feed you a bunch of jargon?
And this is why it matters so much. Think of it as the management quality multiplier. You can have a fantastic business, a real gem, but if you put a bad management team in charge, you'll probably get terrible returns. But flip that around. A truly great management team can take a totally average business and squeeze out really good returns. Leadership isn't just a small piece of the puzzle. It can literally make or break your investment. Okay, so the theory is nice, but let's get our hands dirty. How do we actually use this stuff to analyze a real company? This is where we stop talking about concepts and start building a practical, real-world toolkit. We're going to start with what I think is the most important pillar of all, their track record. You know, you can listen to a CEO give a slick presentation, but at the end of the day, talk is cheap. Execution is everything. So the question is, what has this team actually done? When you're digging into their track record, you're looking for patterns. First, their guidance accuracy. Are they consistently hitting their numbers, or are they always coming up with excuses for why they missed? Second, strategic execution. Do they lay out a clear plan and then hit their targets, or does the strategy seem to change every 6 months? And third, crisis management. When things inevitably go wrong, do they own it, respond quickly, and tell you what's happening? Or do they just blame the economy or their competitors?
Okay, next up is capital allocation. Now, this might sound a little technical, but it boils down to something really simple. What does management do with the company's profits? This is one of the biggest tests of their actual skill. Are they putting that cash to work in smart ways that will grow the business, or are they just, well, wasting it?
If you're going to remember just one number from this entire explainer, make it this one. We are looking for a return on invested capital, or ROIC, that is consistently above 15%. This number basically tells you for every dollar management invests, how much profit they're generating. Getting over that 15% hurdle year after year, that's a huge sign of an elite team.
It's one thing to talk about what success looks like, but you know, sometimes you'll learn the most from seeing how things can go horribly wrong. Because bad capital allocation, it doesn't just mean you get poorer returns. It can literally sink the entire company. And these are the classic blunders you need to watch out for. You've got empire building, where a CEO makes a huge, splashy acquisition just to be bigger, not better. Or they buy back tons of company stock right when the price is at an all-time high. That's just terrible timing. Or a dividend policy that's completely unpredictable. You know, the story of Jet Airways is a perfect, tragic example of this. Poor cash management and badly timed expansion plans ultimately drove them into bankruptcy, and shareholders were completely wiped out.
All right, let's tackle our last 2 pillars. Now, these are often where you spot the biggest, brightest red flags. Think of this section as the defensive part of your toolkit, the system you use to avoid the absolute worst management teams out there. So, let's dive right into our 3rd pillar, corporate governance. The core question here is really simple. Who is management actually working for? Is it you, the shareholder, or themselves?
The true quality of a company's governance really shows up when things get tough. So you have to know the warning signs ahead of time.
So what does a governance failure look like? Well, a classic sign is a board of directors that's just a bunch of the CEO's friends who rubber stamp every decision, or an executive pay package that rewards the CEO even when the company does poorly. If it feels like management is just lining their own pockets instead of creating value for shareholders, that's a massive red flag.
Now for our fourth and final pillar, communication quality. And you know what one of the biggest symptoms of poor communication from the top is? Leadership instability. If you see a revolving door of executives leaving the company, or you hear about constant infighting, that's a sign of a toxic culture. It tells you there's no clear, consistent direction. After all, a brilliant strategy is totally useless if it isn't communicated well enough for the team to actually get it done.
So here's a quick summary of the biggest red flags to watch for. And notice how they all tie back to our 4 pillars, right? Frequent guidance cuts? That's a bad track record. Failed acquisitions? Poor capital allocation. Excessive pay? That's a governance failure. Vague communication and high turnover? That screams weak communication. Seeing a pattern of these things is a very, very serious warning.
So how do you pull this all together into a repeatable process? It's these 6 steps. First 4 are our pillars. Systematically go through their track record, governance, capital allocation, and communication. Step 5, you explicitly screen for all those red flags we just talked about. And then step 6, and this is so important, benchmark them against their competitors. Is this team just okay? Are they truly world-class in their industry?
Finally, you can turn your analysis into a clear decision. Give each pillar a score, get a total rating, and then use this guide. Now here's the most critical part. A team that scores a 3 or 4, you avoid them. I don't care how cheap the stock looks. The risk that they'll just destroy value is too high. But on the flip side, a truly excellent team, an 8 or a 9, those are rare, and they are often worth paying a higher price for.
And I'll leave you with this. You can build the most beautiful financial model in the world, but at the end of the day, management quality is the bridge that connects that analysis to your actual real-world investment results. It's the human element that drives value over the long haul. So now that you have the toolkit, which companies are you going to look at with a completely new set of eyes?